Hello and welcome. We are recording the Core Wealth Monthly Wrap-Up for the month of March. We'll be looking at what's happened in markets and economies around the world. So Russia-Ukraine continues to dominate global headlines. The effect that we saw this having in March was on the supply side, particularly of commodities. Oil price up to almost $140 a barrel at one stage. The wheat price shooting up by about 40% at around mid-March, and the risk of this is that it fuels inflation around the world. We have seen action taken by many of the leading economies around the world having a positive effect on reducing some of these prices. So the oil price at the time of recording now is $102 a barrel. That is because the US has decided to release some of their strategic reserves, 180 million barrels of oil to be precise, a million barrels a day for 180 days. And we are expecting to see the oil price, if we see a speedily resolution to the Russian-Ukraine crisis, coming down to below 100 and getting closer to $75 a barrel. This will be positive for global inflation. In the meantime, inflation is way too high in most of the developed world. If we look at the US, the latest number close to 8%, around Europe in excess of 5%. These levels are way higher than what we've seen historically. And on the back of this, we've seen global reserve banks pushing up their interest rates. 23 of them took this action in the month of March. So the South African Reserve Bank was one of those who increased their interest rates by 0.25% during March. This is on the back of further normalization and expected growth in our economy in South Africa. 2021 saw the economy grow by 4.9%, and we've seen further strength in the manufacturing index, as this graph will show you. If we have a look at other things that have come through in the month, some of them actually weren't very highly noted by the media. One of them was that the Constitutional Court ruled against the labor unions who were pushing for a wage agreement that was negotiated prior to COVID to still be upheld. The benefit of this has been that had it gone against government, they would have had to fork out an additional 30 billion rand in increases to the government sector employees. We think this is a good turnout, from a government fiscus point of view, but also because there's a big disconnect between the level of salaries and the productivity within the government sector. And until that is aligned, we don't think excessive increases in salary should be warranted. The other thing that also happened during the last month was the auctioning of the high demand spectrum by ICASA. And this was something that's been in the pipeline for years now, and there have been stops and starts, and finally it's been done. It's another source, it's a source of revenue for government, but it's also something that can create more productivity in the country as a whole. Then lastly, the news that came through from Moody's, one of the credit rating agencies. This is the third of the three. Now all three have South Africa on a stable outlook, having changed, Moody's now recently having changed it from a negative to a stable outlook. Again, just noting that things are improving within the South African economy. So let's have a look at the markets for the month of March and year to date, which are in the first two columns of this table. So if we have a look at March, we can see that the global equities in rand terms, both developed markets and emerging markets, were negative for the month. However, a large portion of that was actually because of the strength of the rand, which strengthened between 5.4 and 7.2% against major world currencies. That actually meant that in March, the global equity markets for developed markets were actually positive in hard currency terms. If we look year to date, we can see that global equity markets again negative in rand terms, and also actually negative in hard currency terms if you were to convert that back. The South African equity market, the JSE, was up 3.8% over the first quarter, flat in March. Listed property best place to have been in March, but still negative for the year to date after a very strong 2021. The bond market has been a good place to have been, up some 1.9% for the quarter. And if we compare cash, really from a returns point of view, not actually a good place to have been because it's underperforming inflation. So have a look at the columns 3 years and older, and we can see that the best place to have been has been the developed world equities if we look backwards. Emerging markets have not done as well, and particularly of late have struggled because of what's happened in China and now Russia, which both make up a fairly sizable chunk of emerging markets. If we have a look, South Africa, our longer term equity numbers, the 3-year figures are starting to look a lot better, and it's something we've been speaking about for a number of years now, saying that the South African equity market had some catching up to do, which we've started to see coming through. Listed property in South Africa has been negative over the 3 to 5 year period, and we expect that to start doing some catching up, which it did last year, and we expect to see some of that to continue. The bond market has been a good place to have been, but actually the outlook at the moment for the bond market is that the coming years are probably going to be better than what we've seen over the last 3 to 5 years. So if we have a look at our South African facing portfolios for the month of March, it was a bit of a mixed bag. The more conservative strategies with less equity and foreign did better, and those with South African equity and foreign assets struggled because those markets were particularly weak. If we take the income strategy as a whole, if we look at that over the medium to longer term, we can see it's delivered healthy outperformance of its peer groups. And if you have a look over the last year, 6.7%, well ahead of what you would have got if you had money sitting in the bank or in the money market. We're quite happy that over the 1 year and since inception, all of those strategies have got good positive returns and good outperformance of their peer groups. So this table has a look at our US dollar strategies, the 3 strategies there. For the month of March, all of them positive, although the most aggressive strategy underperformed their peers a little bit. That was just because it has more exposure to emerging markets, which struggled during the month of March and over the last year. We can see that since inception, all of these strategies have delivered good returns in hard currency, in dollars, in absolute terms, as well as relatively. The figure in brackets just shows the outperformance of their peer groups, which has been good over the last almost 5.5 years now. From a long-term point of view, equities remain our preferred asset class, both in South Africa and globally. If we have a look, the 2 drivers of equity returns, as you may recall, are what sort of growth opportunities there are and the price that you pay for that share. And what we are seeing at the moment is that we are seeing growth picking up in South Africa particularly, and the prices of South African equities are particularly cheap. Another thing that influences shares in particular is what's happening with interest rates. And here's a graph from Centaur Asset Management that we think points or illustrates this quite well. The graph at the top is just interest rates, and when interest rates are rising or in a tightening cycle, the graph is red, and when it is easing or in a loosening cycle, it's green. And then commensurately at the bottom, we've shown the same period, but just showing the Johannesburg Stock Exchange, and green meaning when the stock market's going up, red meaning either flat or going down. And you can see that those coincide with the tightening and loosening interest rate cycles that we've seen in the past. We think that the South African market is still at least 75 basis points or 0.75% away from a tightening cycle, just giving some upside to the South African market. If we look globally, some of the markets around the world, like the US and Europe to some degree, their valuations are very expensive. There are markets though where that is not the case. So globally, emerging markets are looking very cheap and have done for a while. The Japanese market, the UK market, all look attractive, and these are tilts that we have taken in both our global and South African strategies to try and achieve some additional outperformance. One of the things we think will be rewarded in the coming 5 years is that stock pickers will be rewarded. People who can identify new opportunities at good prices. And the commodity space is one of those. And the change that we're seeing with the increased demand for certain commodities that are linked to electric vehicles and renewable energy is something quite key. Commodities like copper, nickel, lithium and cobalt are all products that will see demand like they have never seen before, and you'd want to see that being incorporated into portfolios. We have added additional commodity to particularly our global strategies over the last while. We've spoken in the past about how attractive the South African bond market is, and this graph from Coronation just shows you all the bond markets around the world. The dark blue line just shows you the yield that you get on their longer 10-year bonds, and the turquoise line just shows you the return after inflation. And you can see that the South African 10-year bond is the most attractive emerging market bond around the world. This will cause demand for that, and we expect to see some good returns in our bond portfolio, and have used these as a bit of a proxy both for equity and listed property because of the high return you're getting without the additional risk that you would take on in the property or equity markets. So that concludes the commentary for the first quarter of 2022. While there is turmoil out there, we are actually seeing a number of opportunities at the moment, whether that be because of the rand strength and the options that gives us in terms of diversifying further offshore. There's some very attractive investments in the equity markets, both locally and in selected places globally. And then from a cash point of view, if you are sitting in cash at the moment, please come and chat to us about the options of putting that either into an income strategy or just a more tax efficient solution. Thanks for watching. Look forward to hearing from you.